Time for personal finance this evening. New guy on the Money Show, Warren Ingram. He's been away so long I've forgotten who he is. Co-founder at Galileo Capital, personal financial advisor. I'm just reading what's in front of me here. Warren Ingram. It's nice to have you back, Warren. Since you've been away, markets are probably lower than they were. Currency is a little better off than it was. And I'm just wondering whether or not you've had time to sit and reflect and ponder what the second half of the year may look like. As hard as it is to believe, next week is the second half of the year.
And I've had lots of time sitting in airports and on airplanes to think about it, Bruce. But it's an interesting thing because when you look at the first half of the year, it feels as though we've had a lousy year. I mean, if you're living in South Africa and you've had load shedding and the economy's really falling off a cliff and unemployment's rising, all of those things, you'd be forgiven for thinking that investment markets have treated us very badly this year. And it's actually not true. Especially global markets haven't done badly at all. And even the JSE is actually up over the year. And so, when we live in this sort of state of doom and gloom, and it's not unique to South Africa, I think, looking at what's going on around the world with the Brits call it the cost of living crisis, but this major inflation problem that's hitting the developed world and emerging markets, interest rates are the only tool that reserve banks have to manage that. And it's causing real economic pain. But having said all of that, the American market is up nearly 15%. The tech-heavy Nasdaq index is up over 30%, and the JSE nearly 6%. And so when markets do that, you would think that with rising rates still not gone and inflation still not disappearing, it's possible that that markets will do badly for the last half of this year and maybe going into next year. And when I look at the data and kind of what goes on for this kind of situation in the past, the history tells us actually that we might be in for kind of a good time for the next 6 to 18 months. Actually, we might continue to see markets rising, and most especially around the JSE and the South African bond market.
And that's because there's some fundamental issues at play here. Inflation, as I said earlier, is closer to the end of its precipitous rise than the beginning. And as inflation and as the central bank, despite some people's belief that the central bank is out to get us and ruin our lives, the moment it feels that it is safe to start cutting rates, it will. And the moment it sends a signal that it's willing to start cutting rates, you'll start seeing a fundamental shift in the way in which investors treat the JSE. And I think it's already happening in the United States, where investors are seeing the beginning of the end of the rate hiking cycle. Even if rates do go up one or two more times, they're beginning to get some hope that perhaps it's close to over.
Exactly right. And I think it's interesting watching the developed markets, and the fund managers and traders around those markets, making some fairly basic, kind of rookie errors that we just don't make in South Africa because we've lived with inflation for so long that, the moment Americans, see kind of one fairly positive inflation number where it's a bit lower than they anticipated, they all sort of forecast that that's the end of the bad news, and almost the following month things are going to be much better and rates will start falling. And then when their reserve bank comes along and says no, it's still not over, they get depressed again. So they're making really rookie errors that fund managers who live with inflation just don't make anymore. It's things that we would see very junior fund managers doing in emerging markets. So the truth is, we'll know inflation is over probably 3 to 6 months after it's actually already peaked and kind of gone out the system. And that's simply because, when you measure inflation, you're measuring history. And it takes time to get all these prices together and to collate them and then to go through the whole system. And then for reserve banks to sit down and have a meeting and actually confirm that it's over. And then for them to do a press conference to tell everyone that it's happened. But what markets are trying to do is anticipate the end of inflation. And I think they don't even need to see a drop in interest rates. They just need to see that rates are no longer going to rise. and they'll start to anticipate that, one day, whether it's 3 months or 6 months later, that then the next move will be down. And the thing about the US market in particular is there is an enormous amount of money sitting on the sidelines, especially in cash, at the moment earning, decent interest rates for once in America, but it's money that needs to flow back into growth assets, especially shares. And so once this kind of chapter in the book is over, we will see that money flowing back in. And I think it flows out of America as well into countries that pay higher interest rates. And that's the story that we're looking for. That's the reason why the JSE will start to recover very strongly, is because, money moves out of developed markets once rates have peaked and start to go down, and they'll go to places where they can get better yields. And the JSE is one of those places. And between the JSE and our bond market, they're as cheap as they've been for the last 20 years, Bruce. And, that is reason on its own to be fairly optimistic about equity growth, although not economic growth.
And this is very hard for people to comprehend now, Warren, because business confidence is at or about record lows. Consumer confidence at its second worst levels ever today. And South Africans is feeling as if they've been left in spread with peanut butter and left in a room with Mike Tyson for a week. It's just battered, bruised, and broken, and everywhere, ears bitten off. And there's just absolutely no visibility of the optimism that you talk about. And I think that's exactly the point, and the point that you are making.
The thing to understand when you're an investor is you need to divorce, firstly always, and I say it as if it's a really easy thing to do, but to divorce emotion from reason. And the reason that's important is understand, number one, that the JSE is not a litmus or a thermometer of the litmus test or thermometer of the South African economy. If you look at the biggest companies in the JSE, and by far they earn most of their money outside of South Africa. And the remaining companies that do earn their income in South Africa, a chunk of them are resources companies, and we know that one of the things that happens when the world economy starts to grow is that the demand for resources picks up. So between the global exposure of the JSE and the mining houses, that will do well, we just need to understand that, the economic problems we have, and they're real, and I'm certainly not minimizing them in any way, that those are not going to impact the price of the shares that operate at the top of the JSE when the demand for emerging markets kicks in again. And I mean, just to understand how that works, you look at business like Richmond, or you look at a business like Naspers or Prosus, right across all the really big businesses that are on the JSE, they just don't earn a lot of money here. So when the story changes, we will see that market pick up. And to understand, the price earnings ratio of the JSE, which is really how you measure, is it expensive or cheap? It's currently just around 10. And over the last 20 years, and bearing in mind, last 20 years haven't been great, but over the last 20 years, the average of the JSE has been around 15. So it's very reasonable to expect that the price of the JSE will rise to the point where it at least meets its long-term average. The only time it's been cheaper than it is now in the last 20 years was this little thing called the global financial crisis. And believe it or not, that was a much worse time for the world than what we are seeing now. So it allies to the South African bond market, which is enormously cheap as well, as cheap as we've seen it in the last 20 years. And that needs to adjust. And both of those, the JSE and the bond market, are going to be very rewarding for investors. What we don't know always is, does that start next week or, 3 weeks time or 3 months time? I don't know the answer, but you can rely on those valuations, as a real benchmark for buying something now, which is incredibly cheap, and you will be rewarded, as I say, in the months and years ahead.
I look for signals, and I look for signals by what influential people are saying about the environment, and gradually and ever so slowly. And they're still very dusty, but I'm beginning to see sensible people begin to make commentary as it's not as bad as you think. Actually, here are a few positive data points. actually this is beginning to emerge. Here is a factor. Here are things, because often we see recoveries in investments and stock markets predate our common acceptance that things are getting better. It takes a long time for us as humanity to go, actually, we've turned a corner. Things are improving. And I just see lots of little prickles of early optimism. I don't want to overdo it, but little prickles of people going, this is doing better, that's doing better, this thing's going well, that thing's going well. Yes, we've still got an electricity problem. Yes, we've got an unemployment crisis. Yes, we've got a currency that is outrageously weak. Yes, we've got companies that are struggling in the face of huge obstacles. But we underestimate human ingenuity in really difficult times to make things better. And I think that is probably humanity's greatest weakness.
And if we talk about survival of the fittest, what you have to say is that the companies that are still operating on the JSE, that are still holding their head above water, are in anyone's definition, now incredibly fit businesses. These are companies with management teams that have had everything, including the kitchen sink, thrown at them, and they're coming out the other side. They have certainly less competition than they've had before, and that's really important to understand. Yes, the market for their goods might be smaller than it was because the economy is not growing, but their market share is certainly bigger, and they are incredibly strong businesses now with management teams that are absolutely fighting fit. And the moment they get any kind of tailwind from economic growth or, electricity that actually works for kind of, an entire month, anything that goes slightly better than it is now, you've got management teams that will thrive in an environment like that. And no one's kind of fat and lazy on the JSE now. They're just simply, the companies that were kind of managed by lousy or average management teams. They simply don't exist anymore. They've been bought up or they've been delisted and bought out. So we are sitting in an environment where we've got really strong, well-managed businesses now. And as you say, any kind of green shoots from here will be really positive. We won't see them. We won't acknowledge them. The newspapers won't write about them until it's all done and we've kind of had, a 15% jump in the JSE and the economy's slowly turned a corner. And then all of a sudden we'll all wake up to the fact that things are less bad than they were. But as an investor, you don't want to be in that position. You need to be early in. In other words, don't try and trade and kind of predict that things are going to get better next week and you're expecting a 10% or 15% jump. What I'm saying to you is, buy gradually now and keep accumulating assets. And the JSE and the bond market are really cheap and really worthwhile buying. And then be patient because, we'll all be surprised when we turn around and look at the good year that we've had somewhere along the line and we'll go, oh, it's not so bad anymore. Things are okay again.
Warren Ingram, co-founder at Galileo Capital. I like to catch you by surprise with questions, and Tebogo sent us a question. I'm going to give you a moment to think about it because I know you've just been on a very, very long holiday and your brain may be mush. I'm in a fortunate position, says Tebogo, because I've been forced to save since I started working through my pension fund at work. I'm currently contributing 7.5% to my pension fund and my employer contributes the same. Aren't you lucky? How do I know if this is going to be enough for my retirement? Should I have additional investments for retirement? That kind of question is music to Warren's ears. An easy one for him to soften him up coming out of his holiday. Tebogo will get onto that in a moment. So Warren, Tebogo is putting 7.5% of his earnings into a pension fund. His company is matching his contribution. And he wants to know whether or not he should be putting more away. I think the short answer is yes, but how and how much?
You're right. It is music to my ears to get a question like this. So I think to understand one big point, Tebogo, is your pension fund will be a nice source of regular income once you retire. But what it won't allow you to do is it won't allow you to draw a lump sum when you need to replace your car, which I know will be only every 10 years, or fix the roof on your house or pay for maintenance, painting or whatever it is. So it's not a great source of lump sums that you will need from time to time. And so, certainly it's important that you keep contributing the 7.5% from yourself and then the 7.5% from your company. But I would suggest that you want to try and allocate some extra money, whether it's to unit trusts or, exchange traded funds or definitely a tax-free savings account, so that you've got some lump sums available when you need them, and obviously you'll never know what they are, if it's a problem, for example, with your house and its maintenance issues or whatever, those will come when they come, but you need to be able to access that money quite quickly and tax effectively. So, I think, definitely want to maximize your tax-free savings account if you can. And if you've still got some extra, then add it to an exchange traded fund or a unit trust. If you want to know how much you need, are you saving enough? The easy way to do a calculation is to take the value of your savings, your retirement savings now, whether that's just your pension fund or your tax-frees, etc. And then, look at how much you've got on an annual basis in terms of your expenses. So if you spend, whatever you spend on a yearly basis, times that by 20. And if there's a difference between, your expenses times 20 and your retirement savings, then you need to keep going. You need to keep saving and get that gap, down to zero. And hopefully, you actually want to have a bit of a surplus so that you can kind of have a bit of a buffer if things go wrong. So that's the way that you can calculate every year. Is that gap getting smaller? Do it at the same time. So if it's now June, then say, okay, great, I'm going to do June every year to see how that gap between my expenses and my retirement fund savings is going. And if the gap's shrinking every year, it means you're doing a good job. If it's not shrinking, then it means you need to save more. I think saving 15% is a good number, but the really top savers will do 30%. If you're not doing 30%, don't get depressed. Just try and, incrementally increase your savings when circumstances allow. But so far it sounds like you're doing a great job.
And that's the point, isn't it? It is about that thing, about not getting completely panicked about this, but actually taking progressive and consistent steps towards doing better, because that is really, you don't want to be destroying your life. You don't want to be destroying your lifestyle. You don't want to be saving so much that you're actually not enjoying, waking up in the morning. It is a case of incremental gains.
I always think about Warren Buffett said, he wouldn't have lived into his 90s if he only drank water and ate broccoli every day. He would have died from despair. And I think it's the same thing with all of us. We are only human, and we do need to enjoy our lives while we're accumulating money for the long term. So balance is absolutely key. And, and sometimes just saving that little bit every month, year after year after year, it can feel like you're not doing much, and it can feel like it's going nowhere. But one day you kind of wake up and you go, wow, I've actually built up quite a nice, lump sum here. And one day when the markets are rewarding us really nicely, that'll jump up as well. And that's the important thing about, saving in times like this, is you're actually laying a great foundation for the future as well. So keep going, Tebogo. You'll be surprised as to how this works out over time.
Warren Ingram at Galileo Capital. Thank you, Warren.